Hello everyone, welcome to FISC Financial Studies classes. This is CFA Level 1 reading number 48, LOS 2 and 3 part 2. In the part 1 we have studied about futures, forwards. Now we are going to study about swaps, options and credit derivatives. So swap is also a kind of forward commitment where the difference between swap and a future or a forward is that in future and forward you are going to make just a single payment at the settlement date, whereas in swap there are multiple payments at fixed regular intervals. So it is more like paying an EMI kind of thing. The structure is such that at the initial you don't have to pay anything. In some cases you have to pay some principal. So when you don't have to pay anything, it is called a notional principal on basis of which return is calculated. It could be an equity return in case of equity swap, it could be interest rate in the case of interest rate swap, it could be a currency percentage in case of a currency swap. So underlying asset could be interest rate, currency or a stock in the cases of swap. One of the example of swap is interest rate swap, where we can see that there is a fixed forward floating rate loan a person is having and he want to convert it to a fixed rate loan. So what happens, he is having a floating rate loan with the bank. There is a swap dealer who says that I will pay you a floating rate and you pay me a fixed rate. So that in that case the person is converting his floating rate loan to fixed rate loan. Now what is the advantage of swap dealer is in doing this is that swap dealer believes that the fixed rate he is charging will be always higher than the floating rate he is have to pay. So he is basically, suppose there is a fixed rate of 5% interest which he is charging with the borrower, then he is believing that with all the at every installment the floating rate, or at least most of the installment, the floating rate would be less than 5%. Now the advantage with the borrower is that he basically is trying to hedge his risk. He don't want to pay more than 5%. He was suppose he is a salaried man and he is having a fixed income, so he is trying to make an arrangement so that he don't have to adjust his budget based on the interest he has to pay every month. There is another example of a swap in which there are two companies. One is Amazon, which is based out of US, and another is Alibaba, which is based out of China. So Alibaba is trying to expand in the US and they want a loan in the US currency, whereas Amazon want to expand in the China and they want a loan in a Chinese currency. But what happens is that a Chinese bank is giving loan at 6% to the domestic companies and 8% to the international companies which are not based out of China, and same rule is there in the US. So in such a case, if Alibaba and Amazon find out each other and they decide that they should take a loan from their respective country banks and exchange it with each other, that means that Amazon is taking a loan of 6% from JP Morgan and Alibaba is taking 6% loan from ICBC, and they exchange the principal with each other and pay the interest in the opposite currency. So what happens, they are getting benefit of 2% interest. In their case, there could be a chance that it is difficult for each party to find their correct counterparty. In such cases, there is a settlement agent or a middleman like a bank comes, who get such players who are interested in getting loan from another country but they are finding it difficult to get a better rate. So they try to find the correct counterparty for each other, and for that purpose the middleman, the bank or any settlement agency, charge some fee. So for example, in this case such entity is there, it may charge 6.5% interest from Amazon as well as Alibaba. In that case, they are going to keep the 1% as a commission. Now we will go and discuss about option. Option is basically the synonym of contingent claim. Option is basically a instrument which gives the buyer a right to buy the underlying asset at a fixed price in the future, and the writer of the option or the seller of the option has the obligation to obey that deal. There are two types of option. One is call option, in which the person having the right has the right to buy, whereas there is another option called put option, in which the buyer or the person with the right has the right to sell the underlying asset. Now there are two different kind of options based on the kind of settlement they have. So if the settlement is only happens on at settlement date, it is called European style option. If there is a chance that some other players can settle their deal even before the settlement date, then that's called American style option. There are some terms which we have to understand in option. One is called exercise price. So exercise price is basically the price, fixed price at which deal has been decided, that in the future the person with the right will buy or sell the underlying asset at that fixed price. The premium is the amount they are paying the writer of the option for the right they are getting. Now if there is value of an underlying asset is higher than the exercise price in a call option, then it is called an in the money call option. Now we are calling it in the money option because, see, if the underlying asset has a higher price and we have a then the exercise price, then in the call option we are having the right to buy at a fixed price which is lower than the market price. So we are going to use our money. That's why the option is in the money. Similarly, if the exercise price is greater than the underlying asset price, that means we are not going to use that option. That's why the option is out of money. If market price and exercise price are equal, we exercise the option or we buy it from the market, we are not going to have any difference. So that kind of situation is called at the money call option. So in a call option, if the underlying asset price is below the exercise price, that means we are going to buy at the market and we are not going to use the option. So the option value is option payoff is 0, but the profit from that situation is less than 0 because we have already paid some premium. In such case, the writer of the call option is getting a profit, though his payoff is again 0. Now what happened, as the price of the stock start increasing from the exercise price, the payoff started increasing to the positive, and similarly the profit also started increasing, though it comes to 0 when the the payoff is stock price plus the premium paid. So suppose there is an exercise price of $50 and the premium paid is $3, so the call option will become profitable only after the stock price the market price of the stock increased to more than 53. Writer of the option will start incurring some loss only after the stock price increased to 53. Similarly, in the put option, if the market price is more than exercise price, we are going to sell it into the market and will not exercise the option. So the payoff is 0, though the profit is less than 0 because we have already paid a premium for that right. And for the price less than exercise price, put option is having a positive payoff, and from 0 to the exercise price, as the price is increasing, the profit of the put option starts decreasing, whereas for the writer the profit starts increasing from 0 to exercise price and it becomes constant after the stock price moves beyond the exercise price. So these are the call and put options. The final term in this session is credit derivatives. Credit derivatives are basically the options on the bonds or credit instruments. So one of the most common types of credit derivative is a credit default swap, which is basically an insurance type of contract in which there is a case when if the borrower is stop paying to the lender, that means there is a default from the borrower side, then the lender will get the amount from the person who has write the credit default swap. So for that credit default swap, he is going to charge a premium each month from the lender. If you really go a lot deeper into this, you try to see what happens because of the CDS in 2008 financial crisis, and you would realize that the main reason for that crisis was the credit default swap. Another type of credit derivative was a total return swap, in which basically one party is giving the loan return based on a bond and it is getting a return based on the performance of a stock. So that is called total return swap. There is also a credit spread swap, credit spread option, in which the return is based on difference between a bond and a risk-free bond or something like that. So thank you very much to watch this video. Please like, subscribe and share it with as many people as you can, and please comment us to let us know that how you are feeling about this video and how we can improve it, and also let us know which kind of topic you really want us to make videos on. Thank you very much.